Good morning. I want to thank everybody for logging in and calling into today's webinar. We were going to talk about being the bank with a self-directed IRA and focusing mostly on how an individual can use their IRA as a private lending source for other individuals. And a lot of times in the seminars we talk about, if anyone who's on here today has been to one of our live seminars or other webinars, we talk an IRA purchasing real estate, actually being on title. But today we're going to switch gears just a little bit and talk about an IRA being a lender, very possibly for somebody else buying real estate, but just a different way in which you can utilize your IRA funds. And we'll cover a lot of the pros and cons of that particular, of being a private lender with your IRA account. Now, as we go through the presentation today, if you are listening live and you're participating in the live webinar, you can type your question into the chat box on the screen. I'll make sure I get to that question at some point during the presentation. If you're listening to this on a recorded version or maybe on our YouTube channel, my contact information will be at the end of the presentation. You can certainly reach out to me with any calls that you any questions you have, any issues you wanted to discuss. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'm also a member of the Florida Bar. I'm a licensed attorney, although I don't do any legal work for any Advanta clients. We'll talk about some potential legal issues today, but I won't be able to do any legal work or draft any documents for someone's self-directed IRA account. I've been with Advanta for over 10 years, handling a lot of transactions and seeing people making investments, and I've also done a lot of teaching and networking and really letting and helping spread the word about self-directed IRA accounts in general. Now, one disclaimer about some things Advanta does and doesn't do, and I will talk today about some legal issues. We might even talk a little bit about tax issues for consideration. But with Advanta, we do not give legal, tax, and also investment advice. So while we can discuss an issue from a legal perspective, or maybe from a tax perspective, we can't tell you how what you should do from a legal standpoint or from a tax standpoint. You would have to talk with a CPA, talk with an attorney. And certainly can refer you to professionals in those areas as well who might be able to assist you. And we also don't give any investment advice. So when you're looking to make an investment in the context today of lending money, if you're looking to lend money to an individual using your IRA, it is up to you to do your due diligence and be satisfied with who you're lending to, any collateral that they're offering. Advanta is not going to get involved in that and tell you whether or not it was a good or bad idea to make that particular investment. Now, we've been around since 2004. Our company has been administering self-directed IRAs since that time. And the only thing we do at Advanta is the administration and the record keeping that goes along with an IRA investing into real estate or investing into private notes that we'll discuss today, or private placements and a lot of other things. We do not sell any investments. We don't provide, again, investment advice. We just provide the service. If you would like to have, you have money in your IRA and you're not happy with it, with your current options, you're not happy with being in the stock market, you want to have more control, we allow you to do that and basically and then choose the investments that you want to hold within your particular IRA account. I think the advantages over our competitors, we have a more personalized customer service experience. We have dedicated account managers who have one point of contact for each client. We also have a more flexible fee schedule than a lot of other custodians as well, allowing you a couple different ways in which you can pay your fees for the services that we provide. Now, in general, why haven't individuals heard of self-directed IRA accounts? Most common reason individuals are probably not familiar with self-direction is the fact they're simply not being offered it by their current IRA or current investment plan provider. A lot of people have an IRA or they have an old 401k sitting with a bank or a brokerage firm that is offering them the ability to invest in mutual funds and stocks and CDs, etc. They are not allowing for an individual to invest in real estate because it doesn't fit within their platform. IRS regulations do allow for each custodian to hold a broad range of investments. The IRS rules as far as what you can and can't do is very limited. There's a lot of different things you can do, but each custodian can decide what it is that they're willing to hold. Kind of a similar analogy when you think of fast food restaurants. If you were to go to McDonald's, McDonald's will sell you a hamburger and fries all day long. They're not going to sell you tacos. They're not going to sell you pizza. It doesn't fit with what their business structure is. So again, most custodians for IRAs will simply hold those products that they sell and not offer you the ability to do anything differently. So they're not going to advertise to their clients that they have the ability to make other investments other than what that bank or brokerage firm is going to provide. So a lot of people simply don't know about it because they're not being hit in the face with it. They're not being told about it. They're having to do a little research on their own to find a company like Advanta that allows for self-direction. Now we talk about the types of assets that people hold in a self-directed IRA. Again, a lot of our seminars, a lot of our webinars are centered around real estate and people buying raw land, buying commercial properties, buying rehabs, short-term investment property, or even a long-term, whether it's a residential piece of real estate, whether it's a commercial piece of real estate, holding it as a long-term rental. If it has a deed, your IRA could purchase it. Again, so whether it's just raw land that you're holding for appreciation, whether it's a long-term rental, whether it's a short-term deal, it doesn't matter. Now, there's certain things and certain qualifications and things you can't do with real estate we talk about a little bit later today, but also in other seminars as well. But as long as it's for investment purposes, any type of real estate can be purchased. We also see a number of other what I call paper assets, and this will really be more the today's presentation will focus on, of the ability of your IRA account for you to take that money, invest it into lending instruments, whether you're investing in a mortgage loan to another individual, whether you're investing in tax liens, where you're buying the lien of an unpaid property tax bill on a piece of real estate. People doing unsecured notes or debenture notes where there is no collateral, or the collateral with a debenture note is stock in a company. We'll talk about some special issues with those types of investments a little bit later today and the kind of things you need to be aware of. We also see individuals entering into options, buying assignments, joint venturing, which is can be structured as a private loan, which we'll go through a case study to illustrate that a little bit today. But the thing all these assets have in common is it's not buying brick and mortar or buying dirt. It's actually buying basically a piece of paper in the form of a note or a mortgage loan. We see a number of other alternatives that we won't really touch on much today, but again, if you have questions on these, please contact our offices. We'll be happy to walk you through any questions you have. But we've seen individuals invest their IRAs into limited liability companies, farm animals, partnerships, movie projects, foreign currency trading, private stock, commodities. The list goes on and on. There's actually quite a number of different unique investments that we've held here at Advanta on behalf of our clients. And we'll go over why there's so many diverse assets that we hold in just a minute, because the IRS doesn't have a list of all of the permissible investments, simply a list of things that you cannot invest in. Now the tools, the question we get a lot of times, individuals hearing about self-directed IRAs, investing in different assets, having it done on a tax-free or tax-deferred basis. What are the tools, what monies would qualify for me to open a self-directed IRA account? Well, if it's any type of IRA, if you have an account designated as an IRA, whether it's an individual, traditional, or Roth account, whether it's an employer base, if you own your own business or work for a small business, you might have a SEP or a simple IRA account. Those can all be self-directed. It's a matter of just simply moving the money from where it's currently held into an account with Advanta that can then in turn be used to purchase alternative assets. So any type of IRA account can be self-directed. The differences between the different types of IRAs, the traditional, the Roth, the SEP, and the simple, is either how much you can contribute to that account on an annual basis out of your pocket, and also the tax treatment. The Roth IRA is a tax-free IRA account. I would invite you to listen to one of our webinars on the specifics we go over into a Roth IRA and the benefits there. So any type of IRA can be self-directed. We also offer an individual 401k plan for people who own their own businesses, who can establish their own solo K. And another big area that gets missed at times, because people hear the term self-directed IRA, but they have a former employer's plan. They have an old 401k or they have an old 403b plan from a past employer. Those funds, although they are not in an IRA there, those funds can be rolled over into an IRA account, into a traditional IRA with no tax consequence, and then in turn be used for self-direction. So again, any type of IRA, any former employer's plan can all be self-directed. We also offer education, health savings accounts, which are not retirement accounts, but they'll follow the same set of rules that we talk about today. Now we get in and talk about private lending. the different types of private loans people can make within their IRA account. If you think about the world, not really looking at the IRA side, just thinking of all the different lending instruments that are out there, your IRA could be involved in any one of those, whether it's just a traditional mortgage loan. Your IRA makes a loan to an individual. They give you a first mortgage on the house that they are buying, so your IRA loan is secured. And it could be a 15-year loan, a 30-year, a 5-year, it could be a balloon note. Any of those terms that you would associate with a traditional mortgage certainly could be done within an IRA. We've seen individuals doing short-term bridge loans, 30, 60, 90-day loans from an IRA account. Just very quick, very, very short-term, high-yield returns within their IRA account. People investing in unsecured notes, where there is no collateral, certainly a much riskier investment. We'll discuss that a little bit later when we go through a case study talking about unsecured notes and why they're risky and other things you need to think about before making that. But it's allowed underneath the IRS rules if you feel that you are comfortable making that particular investment. We've also seen clients structure a deal when they have two individuals looking to joint venture on a project, rather than structuring it inside an LLC or a partnership arrangement, having that structured with a loan as the component instead. We'll go ahead and go through a case study for that in a little bit. And you can also certainly secure your notes with real estate in the form of a mortgage, but there are other assets that individuals have used to secure a note, like an automobile title, livestock, farm equipment, other unique investments as well. Now, the key thing to understanding a lot about self-directed IRAs and what all of the investment possibilities that are out there is to understand what is not allowed within an IRA account. The IRS rules do not list all of the permissible investments within an IRA. They simply list all of the things that you cannot do within an IRA. It's a short list of things you can't invest in and people you can't deal with within your IRA account. If you understand that, then you realize how many different possibilities are out there for making a different investment. The only two things the IRS says you can't buy within an IRA are either life insurance or collectibles. So the only two investments you can't make within an IRA are those two items, the life insurance or collectible. And collectibles would include your antiques, artwork, vintage wines, things of that nature, that the value really is of its rarity. There are some coins that are the gold and silver American Eagles. Those are there is an exception. You can hold those within an IRA account. But any type of collectible coin, and certainly any life insurance, is what's prohibited to be held inside an IRA account. The other area where the IRS has a few limitations is who your IRA can transact with. So there's certain disqualified persons who cannot transact with your IRA, and certain disqualified persons who cannot receive any benefit from the assets held within your IRA account. For your IRA, the disqualified persons include yourself as the IRA owner, your spouse, your parents and grandparents, your children and grandchildren, and also spouses of any children or grandchildren. So your son-in-laws, daughter-in-laws, etc. are also prohibited. And they then include any business or entity that is owned or controlled by one of the above. So the IRS is only saying the only people we don't want you to deal with are just really close family members, people up and down your lineal tree. Outside of that, there's no restriction on who your IRA can do business with, can transact with, can invest with. It's just these small limited number of people the IRS doesn't want your IRA to get involved with. So there's three elements into what the IRS would consider a prohibited transaction. Would be your IRA, a disqualified person, and then a transaction going on between those two parties. So in the case of talking today about private lending, your IRA cannot lend money to any of the people that we just named. Cannot lend money to you, your spouse, your parents, your children. Those are all considered disqualifying or prohibited transactions under the IRS, but no limitations on investing with other real estate investors, other people that you know, acquaintances, friends, etc. Your IRA could certainly do a lot of different deals with those particular individuals. Now, just one note is the IRS has no caveat to that rule. So as far as lending money to a son or to your son's company is expressly prohibited. There's no exception if you're doing it on a fair market basis, or you're doing this particular investment just as you would do with anybody else. simply not permitted to deal with or transact with those individuals. So just a few other prohibited transaction considerations, and we'll go kind of jump into some case studies. Dealing with brothers and sisters, other family members, they're not disqualified. You still probably want to deal with them on an arm's length basis. If you're giving your sister or your cousin a really sweetheart deal that you would not give to any other person, the IRS could look at that and say now that you are benefiting by doing this nice loan, doing something nice for a family member, and you as a disqualified person cannot get any benefits. So if you're going to deal with brothers and sisters, still want to make sure you're dealing with them on an arm's length basis that you would deal with any third party. The IRS will also not allow you to use a middleman between your IRA and a disqualified person. So your IRA lends to a friend of yours, and the friend of yours in turn lends that money to your son or your daughter. IRS would consider that to be prohibited under the step transaction doctrine. The fact that you took it out a step, you put a step in between the disqualified person and the IRA, still going to be a prohibited event. Another consideration, if you have your IRA account lending to a friend, and then in return for that, your friend's IRA is lending right back to you, if you are doing this in kind of in equal terms, and really the purpose behind it is for each of you to pull money out of your IRA without penalty and without taxes by having each IRAs kind of cross-lend to each other, I think the IRS could consider that to be prohibited. Okay, that your intent is not to make an investment by investing with your friend, and your friend's IRA is in turn investing with you on a project, but you're looking to get around the rules of distributions and taxes. The IRS would consider that to be, I'm guessing, considering that to be prohibited. So it's something just to consider if you're dealing with somebody else and their IRA is dealing with you. Probably want to make sure that each deal is really documented. It's a separate transaction. It's a separate investment, so there's no issues of impropriety. Lastly, kind of a question we had come up a few years ago with an actual client. What about your IRA lending money to a third party, but the security for that note, so the collateral basically for that loan, was a collectible, was a piece of artwork? Is that considered prohibited under IRS rules? In real world situation, we had a client do this. We had them sign off on a disclaimer that they understood that there was going to be an issue if they ever had to repossess or go into collections on that particular loan. The transaction was made because the IRA was just lending money to a third party. It wasn't buying the collectible itself, which would definitely have been prohibited. So we allowed the investment. The client signed off on a waiver that understood that if the borrower never paid the loan or stopped paying or was late on payment, that the IRA would have to pursue other avenues other than recollection or repossession. So the IRA would have to basically could sell that note or assign that note to some other third party who could then enforce the terms and provisions and repossess the artwork. So, but it made it an interesting situation, and the client really had to understand what their limitations were going to be should that individual not pay with having that artwork as the collateral for that particular loan. So why do people invest in private loans? For some, I think it can be a time issue. If you are looking at looking to invest in a piece of real estate where you have to contact contractors to do some fix-up work, you have to help get tenants in there, monitor the tenants, etc. Investing in a private loan instead, where you're simply getting a monthly payment into your IRA, is attractive to a lot of people. You simply lend money, you get one monthly payment, that's all you have to do. So it's a low maintenance asset. And when you're acting as that bank and it's your IRA account, if someone's borrowing money from your IRA, you get to help determine or set at least what those terms are going to be for that particular loan. What's the interest rate going to be? What's the maturity date? Any equity participation terms, et cetera, coming back in to the IRA, and then you're kind of setting the rate at which your IRA may grow. You also maybe have less liability than owning real estate directly in the IRA. So some individuals are concerned with liability. If your IRA owns real estate, you'd want to protect yourself with liability insurance or using other types of structures. But investing in a private loan might help you steer clear of a little bit of that liability. Question just came up on the chat box, which is great. I was going to mention again, if you're listening live, please, if you have questions, type them in to the chat box. A question came up and says, who is considered a fiduciary that would make them a disqualified person? If the party is completely unrelated, could other business dealings make him a fiduciary to you? The answer is yes. Now, in general, we talk about disqualified persons. We talk about family members because that's typically the most often that it comes up. But a fiduciary could be someone, if you have a CPA who's doing tax returns for you or for the IRA, is a fiduciary for you, or you're making an investment at somebody else is giving you the advice for making a particular investment. That person is now a fiduciary for your IRA. So you could not lend money, for instance, to a financial advisor who's advising you to place the money with him. You have to be very careful. The fiduciaries, people in that particular capacity, would make them a disqualified person. So a lot of fiduciaries also exist in people who have 401k plans. The 401k plan administrator is considered a fiduciary. For an IRA account, Advanta is considered a fiduciary from that perspective. If we are making a loan from your IRA, you couldn't, for instance, lend the money to Advanta. Now, we wouldn't take that loan anyway, the conflict of interest. But some examples of different fiduciaries. If the party is completely unrelated, could other business dealings make him a fiduciary to you? Again, I think that's possible. It might be a good question to talk with an attorney about to figure out what business dealings that might be. I don't think if you were just doing other investments with somebody, in turn, your IRA then stepping in to make that investment with them is going to be an issue. But even if somebody is unrelated to you, if they're still in a fiduciary capacity, again, as a financial advisor, maybe a CPA who's filling that role with some of their workings, even though they're unrelated to you, those dealings could make them a fiduciary to your IRA. So that's something to check with an attorney probably on more so, and we can certainly give you referrals for that if need be. So great question. Please keep them coming as we go. Now again, if your IRA is making a private loan, one of the benefits that a lot of our clients who do private lending with their IRA feel, and huge benefits, is setting the terms for that particular loan. So when your IRA is making a loan and you're in charge of your IRA and decide what's going to be acceptable, you're sitting in the same place as a loan officer would be at a bank and stating, okay, here's the amount I have in my IRA, here's the amount I'm willing to lend, basically the amount that's going to be borrowed by the borrower. What interest rate is your IRA going to charge and receive? How long is this particular loan for? Is it a short 30 to 60 day bridge loan, or is this more like a 5 to 10 year more traditional type mortgage loan? Is there any amortization? Is it going to be an interest only loan? Or is there any equity participation, which again is something we've seen more and more of over the years, of individuals structuring a loan to not just simply be a return of an interest rate of getting 8 to 10 or 12% on a hard money loan, but possibly taking a smaller interest rate, but including the ability to participate and receive some of the profits for particular real estate deals. And we'll go through a case study on that here in just a moment. So again, the terms that go into an IRA making a loan are up to the IRA owner. The only input that we have at Advanta at sometimes is regarding the interest rate. If your IRA is lending money with no other provisions for equity participation or profits participation, and your IRA is lending at an interest rate of 1%, that doesn't make sense from an investment standpoint when most banks are charging at least 4 or 5%. Conversely, if your IRA was lending money and the interest rate was over 18%, which is considered to be usury and against the law, so your IRA is lending money at 20-25% stated interest rate, that's against the law. That's also, again, something we wouldn't process. So the only time we would have any real input to processing it would be on the interest rate. But it's up to you then. All those other terms, who your borrower is, what collateral they're going to offer, that's, again, what's attractive, I think, for people doing self-directed IRAs and doing private lending is the ability to set these terms and decide what it is that they want to invest in. So we'll go into some case studies, flush out some of the issues, and at least kind of let you know how that process works with a self-directed IRA. So the first deal we have, very straightforward, just a kind of a typical mortgage loan, a first mortgage. Paul has an old 401k account. So he worked for private business, he worked for the school board, whatnot, built up a large 401k, left there, and had money to invest. So he had the $120,000, didn't want to be invested in the stock market, wasn't sure if it was about ready to crash, just didn't feel comfortable with those types of investments and wanted to be much more in control of his investment. So he realized he could loan money out of his IRA and he could control the terms and decide exactly like we went in that last slide what the terms would be in that particular loan. So he worked with a private mortgage broker to find him a borrower, find borrowers who were qualified or maybe borrowers who'd had some potential credit issues in the past, but they couldn't qualify for a traditional loan, but certainly had good paying jobs and were rebuilding their credit. He decides he'll lend his money out of the account as a first mortgage. And the terms the mortgage broker got him, the $120,000 loan at 7% interest with a 5-year balloon. So monthly payments coming in with a first mortgage on the property. So he was kind of holding a CD, but obviously getting a much better rate. And this was secured by a piece of real estate. So he's trying to lend money just to get a better rate of interest than he was going to get a more consistent rate of interest as well from anything else he could invest in his 401k. So what are the steps that Paul would need to take to make this loan happen? His first step would be opening up and funding his Advanta account. Okay, Paul, in this particular client, didn't have the mortgage already arranged, but knew this is what he was going to be doing. So he opened up his account, filled out the paperwork, and then did a rollover from the 401k into the traditional IRA. And a rollover from a 401k into an IRA is not taxable to him. So he's basically able to preserve all of that capital, the $120,000, move it over into the Advanta account. We would help him obviously with that paperwork and giving him instructions on getting those funds rolled over. Now the next step is up to Paul. So we've opened the account, we have the funds here. It's up to Paul now to go out and find the deal, find the investment that he wishes to make within his particular IRA. So he finds the loan, analyzes the terms in dealing with who his borrower is, what the collateral they're offering, what their credit scores, etc. And then ultimately he makes the decision, I'm going to make a loan through this particular individual. He submits a purchase authorization form telling us I'm lending money to Joe Smith at 7% interest. It's $120,000. It's kind of the terms we just went over. Our job will then be to make sure that the note and the mortgage that are drafted that ultimately Paul's borrower is going to sign properly reflect a few things. One, it needs to reflect the terms that Paul told us in our purchase authorization form. Also, it needs to reflect the IRA as the actual lender. So it's important when your IRA makes an investment, whether it's a private loan or real estate, that the IRA is listed as that particular owner. So in this particular case, rather than the borrower signing a note to promising to pay to Paul, you'd actually be signing the note promising to pay to Advanta IRA for the benefit of Paul Smith's, or whatever his name is, IRA account and his account number. So it shows the IRS that this is an investment held by Paul's IRA account. So when the funds leave his IRA to make the purchase and make the loan, that's not a taxable event, and the funds and obviously the income that he generates from the loan coming back into the IRA is also not taxable. And that's an important step of our process. One is getting the account open and funded. Two, making sure the investment documents properly show the IRA as the lender. Once the documents are properly drafted, we will make sure that Paul has reviewed and approved all those documents. So he's going to review the note, the mortgage, any lender's title policy, HUD statement, etc., initial off that he's approved it. Once we have the approval and we have the funds, we can send the money to the escrow agent, the title company, the attorney that's handling that closing. Ultimately, the mortgage and note get recorded and get sent to Advanta for safekeeping. Now, going forward, his borrower, rather than cutting a check payable to Bank of America or to Wells Fargo each month, Paul's IRA is the lender, so that monthly loan check, the monthly mortgage payment, will be made out to Paul's Advanta account, can be sent directly to our office. We will deposit it into Paul's IRA account as cash. Paul can then track his account online. So you can view his account anytime online to see what the status of the payment. Also, our system will send him an automatic email. So when the funds are arrived and deposited at the end of that day, Paul will get an email letting him know how much was deposited into his account. So Paul can track then, make sure his borrower is paying. If not, if he doesn't see an email come through or he doesn't see a payment online, he knows he needs to reach out to his borrower. That's one thing. Advanta is not a loan servicer. We are not going to notify a client that payments weren't received. We have over 4,000 clients tracking payments coming in. That's just not something that we do. So it would be up to Paul to simply make sure his borrower is paying, and if not, decide what action he's going to take. Now going forward, the borrowers in 3 years decide to sell the house, so any unpaid principal, that $120,000 loan, will be paid off at the time of the closing, basically to satisfy his note and mortgage. So Paul's IRA will receive that initial capital back, and all of that interest that was paid during those 3 years has accrued back into Paul's IRA tax-free. The money coming back into an IRA comes back in tax-free into the IRA. Now, he may eventually pay taxes when he takes distributions down the line, but he doesn't have to worry about his IRA paying taxes as he goes. The benefit of investing in a tax-deferred or tax-free entity is the fact that you're not going to have to pay taxes each step of the way. Paul's going to compound his money much more quickly on this particular, because he's not paying capital gains, he's not paying income tax when the money is returning back to his IRA. All right, the next case study, I talked about earlier that we've had clients who've looked to joint ventures, when say two individuals looking to purchase a property or make an investment want to do it together, but they don't want to form an LLC, they don't want to form a partnership. It may just be a one-time deal, and those LLCs or partnerships, the cost in getting those created may not make sense. This particular client had money in her IRA account, wanted to invest in real estate, saw that there was a lot of opportunity to make money in real estate and rehabbing houses, but she didn't have the time or the knowledge to do it on her own, so she looked for somebody else that she could joint venture with, somebody else who might be able, she could provide most of the capital, they can provide the knowledge and the work to actually get this property flipped. So she had her IRA and mutual funds, not happy with mutual funds, doesn't understand the fees that she's being charged, just wasn't happy with the selection that she had, and said, I could probably make more money working with other real estate investors. So she meets Steve. Steve was somebody out there who is buying and flipping houses, or buying and renting houses, whatever his investment features or ideas were. But the important thing, Steve is looking for money. Steve has the knowledge, he has the ability to do the work on the property. Andrea has the capital. So Steve is looking for a $100,000 loan. He can acquire a piece of real estate, get it fixed up, get it sold, and make a profit. So he tells Andrea, hey, your IRA and mutual funds could be used to do this type of deal. Again, it's important before Andrea decides to invest with Steve and lend him, it's very important. She needs to do her due diligence on him as the borrower, and probably also the property that he is looking to flip. Okay, if you think I can take $100,000, buy this property, and get it fixed up and make a profit, it's up to her to investigate that and make sure that that's realistic. It's not going to be Advanta looking out, running a credit check, asking for appraisals, etc. That's going to be all up to Andrea to decide. But when she's satisfied, ultimately she will offer to lend him $100,000 to buy and fix up that property. Now here's how she structured the deal. Now again, Andrea could go back, similar example with Paul, and just done a $100,000 mortgage loan, and maybe she would have charged Steve 10% interest. And then he would just pay her 10% interest, close on the property, rehab it, fix it, sell it. She would just end up getting 10% for the life of the term while that loan was outstanding. But Andrea knows that Steve is probably going to make a decent profit because he's good at what he does. As she's heard, she did her research. She would rather have a percentage of the profits rather than simply a higher interest rate. So she structures a deal with Steve where he simply pays a 5% interest rate, but she will also get 1/3 of any profits back into her IRA account as well. This is more, again, a situation where they could have agreed to set up an LLC where she put the money in, He did the work, they split profits at the end through the LLC or LLP, but by structuring it instead to a mortgage, might have been do it just a little bit easier and a little bit simpler by doing just a simple note and mortgage and putting in the note that Steve, when he pays off the loan, has to also include 1/3 of any profits over and above the $100,000 that he borrowed from her. And in this case, Andrea also gets a first mortgage, so she has protected someone on that property that if Steve were to walk away, her IRA can foreclose if need be to take the property back. So again, the structure of this particular loan was to include some of the joint venturing alongside the interest rate that she was going to get. It'll be up to Andrea's attorney to prepare the note and mortgage, or title company, whoever she uses to prepare the note and mortgage. Similar situation with Paul. She's going to set up the IRA with us, do a transfer from her current IRA over into Advanta. Again, transfers also are non-taxable events to move money from one IRA to another. Has the money here, directs us to make this investment. Again, our job will be to make sure that the note and mortgage drafted by her attorney properly reflects her IRA as the lender. So Advanta IRA, for benefit of Andrea's IRA account, needs to be listed on the note and mortgage as the lender. And Andrea will need to mark those documents as read and approved. Again, approving and saying, yes, I looked through the notes, the wording for the profit split is correct, the interest rate, etc. I want to make this investment. She sends us the purchase authorization form. Again, we will want to make sure simply that the terms in the note match what she's told us on that particular form. The loan is made. Steve takes in the cash, buys the property, gets it rehabbed, and he goes to sell it 6 months later for $130,000. So there's a $30,000 profit on that particular rental, on that particular rehab. So he asked for the payoff amount. When Andrea is calculating that payoff, she's going to say, okay, it was 5% interest on a monthly basis plus 1/3 of the profits that were made on a particular deal, and let the title company, the attorney handling the second closing, know what the payment payoff will be back to her IRA to satisfy the note and mortgage. So for her IRA, she gets back 6 monthly payments of interest into her IRA while the project was ongoing, and she gets a percentage of the profits back inside her IRA account. So she ends up with a pretty healthy return on her $100,000 investment by structuring this as an equity participation or joint venturing deal. If she'd structured it simply as a 10% interest loan during 6 months, she would have got back about $5,000. But by adding the profit participation in there, she's able to get a larger return back to her IRA. And from Steve's perspective, he was able to borrow money from somebody else's IRA account, not use much of his own capital, and not go through the hassle of trying to get money from a bank. He still ends up with some earnings at the end of the day, even after paying back the profits and the points and the interest, getting funds back in his account. So this last slide, I think, illustrates a lot. If someone out there listening or watching on YouTube, even if you don't have your own IRA account, but you're a real estate investor, this is why self-direction makes sense and why you need to know about it. If you're out there looking for money and you're out there looking to solicit for investors to invest in your projects, you can still make money using somebody else's IRA account. Another bucket of money, another tool you have that you could invest in when you're seeking investors and letting them know what cash and what capital is out there, what could be used. Now, a couple of notes. The last two examples we talked about had real estate as the collateral, and that's usually the common, probably 90% of the loans we do at Advanta have some type of real estate backing as the collateral. But what's some other considerations if you don't have real estate? Now, we went over the issue with prohibited investments as collateral. If you have a life insurance or a collectible, it can make collection difficult. It's not prohibited per se, but it's just something to think about. Also, if you were securing the note with stock in a company, a lot of times referred to as a debenture note, where your IRA lends money to a company, and in exchange for one of the terms of the note is they can pay you back the interest rate, or they can elect to satisfy your note by giving you stock in that particular company. So your IRA could go from making a simple loan to owning stock in the company. A couple things to consider. If you are lending money to an S corporation with a debenture note, and a company taxes an S corp, And S corporation rules prohibit IRAs from being shareholders. The S corporation rules require that all shareholders and owners be individuals. So your IRA could not end up owning stock in an S corp. If your IRA invested in a partner or lent money to a business on a note that was secured by stock in a partnership, and your IRA ends up getting partnership ownership interest, your IRA could be subject to what's called unrelated business income tax if your IRA is eventually in receipt of business profits as opposed to dividends. That's kind of maybe a different discussion for a different day, but just be aware of that. And lastly, if you were loaning money to somebody and the collateral is not real estate, what are you going to use as a security agreement, and where is it going to be recorded to put other people on notice that your IRA has a lien or an interest against that particular asset? The great thing about mortgage loans is the fact that mortgages get recorded in the county where the property is located. They become a cloud on title, so if anyone tries to purchase that piece of real estate down the road, they have to satisfy your mortgage. But if your IRA is lending money to someone and the collateral is some equipment, it's other assets that don't have a readily place to record a collateralized agreement, just again something to be considered. How are you going to perfect your security interest in that particular asset? Now there's UCC filings, there's other ways you could go with that, but just again something to consider when you're using something other than real estate as collateral. Now we had another question came up that says, what is the best way to find potential borrowers for money in my IRA? One thing we don't do at Avanta, we certainly would not place your IRA funds with an individual or say, here's I think what you should do. But you might find a lot of potential sources if you were to go to a private mortgage lender. You look online and find a private mortgage broker who could help bring you deals and say, hey, here's some people I have that are looking for mortgages. You can look over at their file and decide if it's a loan you want to make. We've also seen a lot of people at local real estate networking clubs and networking groups. You will always find somebody there who is looking to borrow funds and borrow money. Again, just you need to do your due diligence on those borrowers. So I think local real estate investment clubs, going to private mortgage lenders, and private mortgage brokers would be probably your kind of two of the better ways, at least to find potential borrowers for money in your IRA. Next case study, Tom is looking to do a loan to a friend, and since he's lending money to his friend, he is not concerned with having any type of collateral. So he's got some money in a SEP IRA. Again, he's self-employed, so he can put more money into that account. But a friend is just looking to expand his business. Okay, he has a good little business going, but he needs some more capital injected to get some more growth. Be a short-term deal, no more than a year or so. But Tom's friend really doesn't want to sign a mortgage over, and Tom doesn't want to go through that hassle or through the cost of actually getting a mortgage recorded, etc. So Tom decides, I will lend money to my friend who's been a longtime friend. I trust him implicitly, and do so on an unsecured basis. Okay, so there'll be no collateral for loan. Tom's IRA is simply making a loan to his friend. His friend can simply pay back on the note. So Tom, again, like Paul and Andrea before, would need to set up an account, transfer money in from the SEP to a SEP IRA with Advanta, and then direct us to make the loan. And this particular client lent $50,000 at 10% for a year with just a lump sum payment due at the end. This example illustrates a few things. One, that you don't have to have collateral. Now, it might be advisable in certain circumstances, or you might be an individual who says, I will not do a loan without collateral just to protect myself. So it just illustrates that you can make loans with your IRA without collateral, not against the rules. It's just a little riskier. Also, the terms here in this particular loan, just a flat interest rate, but also just a lump sum payment. Okay, $55,000 due at the end of the year. When your IRA is making an investment into private loans, the terms, again, the payments, frequency of payments, etc., is up to you. So Tom decided, hey, we'll just do a one payment at the end of the year. When the business is growing, you can just pay me back all at once. Or Tom could have structured it where his friend made monthly payments, monthly interest payments, or quarterly payments. Again, the example just illustrating that the terms can be very flexible and up to the individual account owner. Now, when you are lending money with unsecured notes, again, a couple special considerations to keep in mind. Because there is no title company or attorney involved, when Advanta funds an unsecured note on behalf of one of our clients, we must get the original note in our possession before we can fund, before we will release cash from the account. Now, when you're doing a mortgage loan like Andrea or Paul did before, where that money is going through a title company or going through an attorney's escrow account, we can fund that mortgage before all the documents are signed. Reason being, the title company attorney is responsible for making sure everything gets signed and gets properly recorded. But with an unsecured note, the only thing to do is to simply sign that one particular unsecured note. So we will not release funds to your borrower until we have in our possession the actual signed document, because there isn't going to be anybody in between making sure that that happens. Now, typically with unsecured notes, those are riskier loans. There's no collateral involved, so the interest rate tends to be a little bit higher. Credit cards are a form of unsecured lending. We all know that credit cards have a higher rate of interest. But also make sure you know your borrower. It can be very difficult to recover in default situation. If you have an IRA as lent money secured by a mortgage, there's a legal process to follow. If somebody doesn't pay you back and you have a mortgage on a property, you can file for foreclosure and go through a legal process to ultimately recoup a portion of your investment or get the property back. But if you have an unsecured note and someone's not paying you, your only option is to take them to court, basically sue them underneath the terms of that note. And if that person were to ever declare bankruptcy, an unsecured note is going to be at the end of the line for the list of creditors. So make sure you know who you're dealing with before getting involved in that type of unsecured note. Now, our last case study, we're going to touch on buying real estate within an IRA, and how you can turn that then into a portfolio of loans. This is a client we've had who's done this a couple of different times, where he had money in an IRA account. He has money in his traditional or Roth or traditional IRA account, wanted to buy foreclosures and get them fixed up. So he goes to the courthouse steps to buy these properties cheap, puts a little capital into them, get the property fixed, and ultimately looks to then sell that particular property. So Jim would set up his account, again, going through the paperwork process, getting funds transferred over from his current IRA, and then finds a property he wants to purchase. Okay, we would make sure on the closing, when he's buying the property from the courthouse, that the property, the real estate, gets titled again in the name of his IRA account. He's then going to use funds from his IRA to fix it up and look for an end buyer. Now, what Jim does, kind of different from a lot of people who flip houses. A lot of people who would flip a house simply look for the big payoff at the end. I've bought the property, fixed it up, when it pays off, I'll just take that huge lump sum. But what Jim did is he actually looks for someone who's going to buy the property, who can make a down payment, if we pay a portion of the purchase price up front, and then he will agree to have his IRA finance the balance of that purchase price. We do a seller finance deal within his particular IRA account. And when he does this loan, again, the interest rate a little bit higher because he was dealing with individuals who didn't have the greatest credit. They had a sizable down payment to make at least, so he had some security for the loan, and also got a first mortgage. So it was a $70,000 loan, 8% interest, with a first mortgage on that particular property. So for Jim, his particular deal, again, he set up the IRA. His first step after he got the IRA set up was to buy the property. So he's bought the property at foreclosure. Again, we work with him to make sure that that Advanta IRA for benefit of Jim's account was on the title of the real estate. Get that property purchased, go through the closing process. Then when he fixed up the property, so he had $10,000 of repair costs, he would send us those bills. We would pay his contractors, get the property fixed up. And when he put the house back on the market, he got his down payment of $10,000, so basically he got back his repair costs, had the new buyer put down $10,000, and he agreed to then hold a note in his IRA for the balance of the $70,000 that was due to his account. So again, our job at Advanta was to process the initial purchase. We sent the checks out for repairs, as his IRA owned the property, and the expense, we paid that bill. He'd send it to our office, we get it paid. Then we process the paperwork for selling the property to the new buyer, and also then making sure that the new buyer, when signing their note and mortgage, again showed his IRA account on that note, on that particular mortgage. So our job through the entire process to make sure the wording on all of the documents correctly show the IRA account as the owner of the property and then subsequently the holder of the note and mortgage. And at the end of the day, after the second closing, so he closed once to buy the property, the second closing was to sell the property and get the carryback or the seller finance loan inside his IRA. He ends up at the end of the day with his borrower simply making a monthly mortgage payment, loan payment, back into his IRA account. So he gets monthly cash flow to his IRA for this piece of property, but he's not having to pay any expenses because he's simply holding now the note on that particular property. So he identified a property, got it at a good price, got it fixed up, found the new borrower and the buyer for the property, agreed to lend him the money. He ends up basically getting a note at a discount. If he ends up with a $70,000 first mortgage loan within his IRA, he really only paid $40,000 in cash by buying the property. So he kind of got that note at a discount. If you have any questions, let's get them into the chat box if you can. Kind of concludes the prepared portion of today's presentation. If anyone has any additional questions, go ahead and type them into the chat box. We'll get them answered. I would encourage you, though, you can also certainly call me. My number is here on this last slide. My email address is as well if you'd like to call. Email me any questions you have regarding your account, regarding setting up an account, questions on the process, on the rules. I'd be more than happy to sit with you and spend the time to do that. You can also visit our website at advanceira.com for the other upcoming events and seminars. We do multiple events each month, whether it's an online seminar, an online training like today, or whether it's a live training in either our Tampa or our Atlanta office locations. You can go to a live seminar. We also do a lot of networking events that also get put up on our website. So the website is not only a great resource for the upcoming events and information, there's also a lot of other great information on the types of IRAs, the types of investments, etc. And you can go to our YouTube page as well to see other recordings that we've done. So questions, we did get one question. Again, if anyone else has any others, please throw them out. It says, what are the typical interest rates you see for lending on flip houses, basically hard money, and the terms? I think typically we see in the range of probably somewhere between 8 and 9 and probably 12% as far as interest rate. Typically the terms, the length of time, usually those loans are for no more than a year or two, just to give the person plenty of time to get the property fixed and flipped. So it's typically just a straight interest rate of probably anywhere between 8 and 12%, and the length is usually a year, sometimes maybe a little bit more. And sometimes these loans are also interest only, where the payments simply come back on a monthly basis, but it's only of interest, not of any principal. Again, that's completely up to you to decide. That's just typically right now, I think, what we're seeing more of. The rates around 8 and 12%. So again, I want to thank everybody for coming on and logging into the webinar today. Anyone who's watching on YouTube, it's great. And again, if you're watching today and you want to learn more, go to our website, find us on YouTube. There's a lot of other informational webinars that we've done on buying real estate using LLCs, a checkbook IRAs. There's a lot more that we'd be happy to help you out with. Or just give me a call or shoot me an email. I'll be more than happy to talk with you as well. So at this time, I'm going to conclude the webinar, and I thank everybody for attending.